we are assembled, and we'd like to introduce yourselves and your guests, and then we'll go from there.
Sure, that's fine.
Go ahead.
I can go. I'll do it. Okay, that's fine. I just ran up the stairs, so I apologize for being
Oh, you're young yet.
not as young as I used to be. My name is Bret Holland. I'm with Stifel Financial, and my business partner, Mike Battistelli, also with Stifel. And we have Mr. Chris Jamison today with Uniplan. He's the president and CEO of Uniplan. And Chris will share, obviously, a little bit more here in a few minutes, but they're the manager who oversees primarily the REIT portfolio, the real estate investment trust portfolio, which represents a little over $8 million in your portfolio. So with that, we'll get started. Chris is going to speak a little more specifically to the REIT portfolio. We just wanted to just take a few very brief minutes just to kind of give an update as to where we are for the year so far with the economy and kind of what expectations look a little bit like going forward. The word for this year has been, and everyone in the room knows, it's inflation. That's been the entire conversation surrounding the economy this year. With inflation, the Federal Reserve, which is a division of the government, is trying to counteract inflation, and they basically said that that is their number one goal, is to deal with inflation even more so than necessarily looking after what's going on in the economy. They're willing to sacrifice some growth in the economy in order to bring down inflation. So we've had a total of about 3.75% in the way of interest rate hikes this year. Interest rates have gone up about 3.75%. And although that might not sound necessarily like a lot to us here in the room, just to kind of give some perspective, 1994 was considered a very difficult and very aggressive time for raising interest rates, and it was about 2.5% in 1994. So today we're at 3.75%, and we're anticipating probably another hike in December, possibly. But just to kind of give some perspective of how that affects investments as well, if you look at a 10-year Treasury bond, which is considered to be the safest investment in the world, it's considered, they call it a riskless investment. If you bought that in January, back in January 1st of this year, you're down about 15.5%. So more or less your investment has dropped 15.5%. If you go out to a 30-year Treasury, just to kind of give an idea with that, which is also considered, again, one of the safest investments in the world, you're off by about a third, about 33%. So these might seem like small interest rate hikes when you hear it on the news, they have pretty profound effects on what's going on in the investment markets. The economy is slowing, which is what the Federal Reserve is essentially trying to accomplish by trying to bring down inflation. And the biggest area that we're seeing slowing right now is the housing market. Mortgage rates, again, just not to keep throwing numbers around, a year ago you could get a 30-year mortgage for about 3%. Today it's about 6.5%. So that kind of slows things down as well. Most of the economists and so on that we would follow at Stifel that we would have confidence in are saying there's a pretty slim chance that we actually avoid some type of a recession in 23. However, most folks are saying, as a majority, that recession would probably be somewhat brief and somewhat shallow. So we're not anticipating anything extremely disastrous at this point. The three main reasons why that might be somewhat brief and shallow is, one is just the balance sheets of U.S. Americans, of U.S. consumers. There's all kinds of numbers, we won't go through that today. People's checking accounts are in better shape today than certainly what they were just a few years ago. And certainly if you go back over the last 15 years, where U.S. consumer, or U.S. taxpayer I should say, is in a much better spot today than what they were 15 years ago. The second thing is just the unemployment rate. Everyone hears about the unemployment rate being around 3.7%. Although we do anticipate that moving up some over the next year, we still feel like that will be at an attractive rate. And then the last thing is just the fact that our banking system, what we talked about when we came in here and met, when Mike and I came in and met back in 2008, our banking system was in a very bad spot at that time, and today the banking system is in a very good spot. So those are a couple reasons why we don't feel like if we do end up going into a slower time in the second half of 23, why we feel like it should not be too terribly bad as of what we know today. So that being said, I'm just going to have you go to your report if you would, and we'll kind of go through some specifics in that. Any questions on my comments there?
No, it sounds like you spent at least 2 semesters at law school, though, with your answering sort of valid.
Oh, I did?
Covering all sides of it, but that's good. That's very, very good.
Can't tell if the heavy breathing is still from the steps or the nervousness over the numbers.
Thanks, Jamie.
It was law school or is it economist, one or the other?
So if you go to page 4 of 11, which is the page we always start with there, page 4 of 11 has our numbers. Again, this report is through the end of September 30th. We always say the same thing. Mike will have up-to-date numbers, which are much more attractive than what these are. The quarterly rate of return, if you can see up there in the top left-hand side, we began the quarter, which would have been July 1st, obviously, at $126,669,614. We had withdrawals of about $2.7 million. We had a return or a loss of $5.8 million, and then the balance at the end of the quarter was $118,074,120. The column to the right of that, there you can see that the column to the right of that, beginning of the year we started at $153 million, had withdrawals just shy of $6 million, and then a loss this past year of about $29 million, and again, the $118 million. Any questions with that at all?
Mike, any questions?
Okay.
No, none from me.
Bottom right-hand corner just kind of shows the allocation breakdown, and just simply showing our cash balance today is about 0%. There's a small portion in cash, but doesn't register on there because it's such a small percentage. Moving around clockwise, equities are about 63%. Fixed income, or your bond portion, some of that portion I was talking about earlier that's struggling with interest rates, is about 30%. And then alternative investments, which is primarily the REIT portfolio, is about 7% in that. And I'll have you go to one more page. If you go to page 6, and page 6, kind of, this is all the different managers and different accounts that we have listed for the county, and kind of the bottom line there, if you will, on the far left just says total. And we're going to move across to the 1-year period there is what it is. If you see the column, the 1, 3, 5, and 10-year period. But the 1-year period, so September of last year through September of this year, the account's down 14.16%. The 3-year number is averaging annually 1.95%. 5-year number is 4.23%. And then the 10-year number, which I know is important, is the 5.83% per year is what that is. So any questions with that?
I guess my only question, and it's an overall question, not just this page, but after next year, when we come out of the very short recession that you promised, I'm going to hold you to it.
Didn't promise that. Didn't promise that.
Do you see us recovering and recouping all of our losses, and our pension fund is back up to where it was before?
That's a fair question, Commissioner. We can't guarantee anything with investments, but
I'm just looking at your expertise with the history.
I heard yes.
historically things do recover. Yes, I mean the big thing that we focus on, not just because it's a positive number, but that 10-year number, that it's either a 7 or 10-year number, and the 10-year number is what I believe you defines your obligation for what you all need to put in to the pension. So that's the area where I'd be focusing at. A year ago we came in here and the numbers were really high. This year they're low. So it all comes down to averages. So to answer your question, I would say over time I would feel that things would recoup. Yes.
Was our assumption 7.15, or where are we on the assumption?
7.25, I believe.
It's
7.25, okay.
Yeah, and even that's been great for the last 3 years. We've just blown away the assumption. Of course, a drop this steep affects that, but even a slight increase will bring all 3 of those up. So
I really
too worried about the assumption.
I really appreciate your words, because I think it's important to reassure our retired employees that, well, we can't go back and give them COLAs and things like that, that it's important for them to know that their basic payments, because they have a guaranteed payment, which is unusual out there for pensions, but it's still secure even though the market is down. They need to hear that once in a while so they don't stress over it. So thank you.
The reality is if it's down, their payment's still secure because the general fund has
Well,
to make it.
that's what I mean, but if we'd run out of money, it wouldn't be secure is the point, if it would go down that far. But I think that it's going to come
We'd
back
still owe
up.
it though.
Yeah.
We'd still owe it.
Oh, of course, we'd have to borrow it from the bank.
But I'm
Or
saying,
raise
But
taxes.
it just makes it more stressful and it costs us more. But they need to know that their money is secure.
Well, you all have done a very commendable job, though, of having the funding. I know that's been a big focus in the last 10 years of making sure that the pension is secure, and that's a result of your work, quite frankly.
So,
With your guidance.
So,
yeah.
anyhow, with that, I'll
Okay.
pass it to
Okay,
Mike.
here, ta-da.
I'll just give you some up-to-date numbers through yesterday's market performance. So through yesterday, we are now down 13.05%. So last couple months have been better. And so the portfolio has bounced back some, kind of talking about bouncing back. So if we get the right indicators, the right numbers, the market can lift us. So the balance, again, through yesterday, 126,665,330. The net withdrawals, 6,727,387. And that performance numbers, just to put that in perspective, we don't really talk about benchmarks. I think that's a moving target. Our allocations change and so on, so benchmarks tend to be static. But just to put that 13.05% number into perspective, the S&P 500 index for the year is down 15.76%. The NASDAQ, which is a lot of technology and growth stocks, is down 27.4%. As Bret mentioned, the U.S. bond aggregate index is down 13.17%. And then an index that would be comparable to how the pension is set up, roughly a 60-40 allocation, is down 14.72. So on a relative basis, particularly that last index, I think our managers are doing a good job of trying to protect on the downside. And that's kind of how we've always built the portfolio for the pension, is be a little bit more defensive. Even in the really good times, if we don't quite capture all that upside, it's now when the market's down that we want to be focused on protecting. Okay.
Oh, I'm sorry, go ahead.
Yep, allocation-wise, stocks again are at 61%. The real estate portfolio is at 6% allocated. Bonds are at 27%, and cash is about 6%, just under 6%. So right now, we're comfortable with the allocation that we're in. I don't really feel like we need to be making any significant changes, but just a few comments. C.S. McKee, if you recall, back in 2015, I believe it was, actually shortened up the duration or the maturity of their bond portfolio, and that was in anticipation of rates going higher. Okay, in 15 and 18, they did we tested the markets a little bit, and the rates did go up a little bit. The market didn't receive that too well when that happened. But we've been kind of shorter in our duration in C.S. McKee. That proved to be probably a pretty good move at that time. As Bret mentioned, with the Treasury notes, the shorter the duration, the less effect it's had. As you go out longer in maturity, those bonds have been down more. Most bond managers now are starting to add duration, starting to get a little longer. If we happen to have a slowdown, as Bret was mentioning, a mild recession, we'll call it, the anticipation would be that the Fed would stop raising rates and potentially even start to cut rates at some point down the road. And if that happens, we want to be longer in duration. So just so you're aware of that, probably in the next 4 weeks, C.S. McKee will gradually start adding some duration to their bond portfolio. Okay. And then I think the other thing that we've been talking about, Bret and I and Sonia, who's not here today, is starting, if we do get somewhat of a rally and October, November so far have been pretty good. If we continue to get some rally, we're probably going to look at raising some more cash for the next 6 months for your distributions. That way, if the market continues to go up, we can let the equities and everything grow. If that market happens to dip back down, we don't have to go sell things.
So you don't want to take it out of the stream.
Correct, correct. So if we can get some growth and we can raise some cash, we think that's the right thing to do. And 6 months, hopefully, would put us to a point where you're at a point where you're making maybe a contribution into the pension. Usually do that in June or July timeframe. So just wanted to add those comments. Okay. Any questions regarding that?
Okay, Commissioner Kuhn, any questions for?
No, thank you.
Okay.
I don't know, Chris, if you're going to talk at all about recession prediction or anything.